Depreciation is a powerful tool when it comes to real estate investing. You're going to learn how it works right now. When you own real estate, the amount of money you keep as profit is probably different than the amount of income you report on your tax return. The difference probably comes down to two things. One, you can't deduct mortgage principal payments on your real estate tax return. Two, you get to deduct something called depreciation. Why is that, and how does it work? It costs money to buy real estate. If you owned any other business and you pay money for something to be used in your business, that's called an expense. The theory is you bought something this year, you use it up this year to make the thing that you sell this year. When it comes to real estate, you don't use up your real estate each year to turn it into something else. It's not like you're carving bricks out from your building and selling them. Because of that, when it comes to real estate, like if you buy a residential rental property for $400,000, you don't get to deduct that $400,000 expense in the same year as when you buy it. You're supposed to deduct your cost over the whole time frame that you're using it up. When you buy a property, it consists of land and buildings. The buildings won't last forever, but the land will. If the land lasts forever, then it's not getting used up, and you can't deduct the cost of that land as an expense. You paid money for it, but you will always have the same amount of land as before, with theoretically the same value. Because of that, you cannot depreciate land. Buildings, though, need to get updated over time, and a 10-year-old building is not as nice as a new building. So the tax code needs to some way account for the expense, your cost of buying that building and using it up over time. The way it does that is through depreciation. And for residential real estate, that length of time is 27.5 years. If you bought that rental real estate for $400,000 and the land is worth $125,000, then your building you bought is worth $275,000. You don't deduct the cost of land. You can't depreciate it because that land is not getting used up over time, but you are using the building. Take that value of the building, $275,000, divide it by 27.5. And now you have the amount you get to depreciate against your revenue in future years. In this case, it's $10,000 per year for the next 27.5 years. When you pay money for a building, it's not called an expense because an expense is used up right away in that year. It's called depreciation because theoretically that building gets used up and decreases its usefulness every year. Things that get more and more used up have less chance to appreciate in value, which is why it's then called depreciation. Of course, there's a lot more to taxes than just depreciation. Check out my next video, how to save $100K or more in taxes for your retirement. I'll see you there.